Hello, and welcome to Virtual Investor Conferences. On behalf of Virtual Investor Conferences, we are very pleased you've joined us for our Oil and Gas Conference. Our next presentation is from Kolibri Global Energy. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book a Meeting in the top toolbar. At this point, I am very pleased to welcome Wolf Regener, President, Chief Executive Officer, and Director of Kolibri Energy, which trades on NASDAQ under the symbol KGEI and on TSX under the symbol KEI. Welcome, Wolf.
Thank you, and thank you everyone for joining us today. Let me go through these slides. We'll start off our forward-looking information, disclaimers about non-GAAP measures, etc. You can find all those on our website on our corporate presentation. Getting into some details on the company, Kolibri Global Energy, we operate in Oklahoma. We operate the Tishomingo shale oil fields there. We try to run our company in a financially stable fashion, have low debt. We've had really good cash flow growth. We're looking to continue that as we go forward. We have really high netback production, so how much we make per barrel of the oil coming out of the ground. We were fully funded for our 2025 drilling program using our existing cash flow and our existing line of credit. Our line of credit is with the Bank of Oklahoma as lead of the syndicate, and we have a $65 million line of credit that was recently reaffirmed, even with the low oil prices. We've got what we consider a great asset with 40 million barrels of proved oil and gas and 53 million of proved probable oil and gas. Of the proved oil and gas, at the end of last year, it was about 22% was in the proved developed producing category. The rest was proved undeveloped. And that is obviously going to change because we've drilled a number of wells this year. Last year, our proved reserves grew by about 24% because we drilled a number of probable and possible categories. And that moved that into the proved category. A bit of company information. As we mentioned, NASDAQ traded KGEI on the TSX as well, KEI. Share price has been hovering around $4. It's, as you can tell from the graph on the left, we've declined a bit as oil prices have come off as well. Our market cap is down to about 145 million. We had about 42 million in debt at the end of last quarter, and we plan on early in first quarter to pay that down by about 8 to 10 million because we have some wells coming on production here in a little bit. So that gives us an enterprise value of about 188 million, keeping our debt to EBITDA around 1. That'll come even lower when we pay down some of the debt. And that compares to our proved reserves at the end of last year by Netherland Sewell, which is a very reputable reservoir engineering firm, gave us a valuation of 535 million compared to our enterprise value of 188 million. So you can see where there's a lot of value there. Was it higher oil prices than where we are now? But I do foresee oil prices recovering in the future. The history of the field, as I mentioned, we're in Oklahoma. We're about halfway between Oklahoma City and Dallas. And we originally drilled for what's called the Woodford Shale. So the Woodford Shale was very gassy. It's only about 15% oil. And I forgot, I don't have a pointer unless I do that. It's only about 15% oil. And the balance was gas and natural gas liquids. And if you look on the right-hand side here, you can see that purple areas is where Exxon was buying everyone out. So we were the last holdouts, actually. We ended up selling our 12,500 acres that we had at the time to Exxon for 147 million. But really what we did was we held on to the rights of those intervals that are just above the Woodford. It's the Upper Sycamore and the Caney, because we just drilled a well to test the Upper Sycamore and the Caney. We were making oil and gas out of it. It wasn't economic yet, but we felt like we could make economic wells in the future. They didn't want to pay us what we felt it was worth. And we're the only ones that were able to hold on to these upper intervals in this entire 280,000 acre trend that Exxon was buying out. So since then, we have developed the Caney, and you can see now last quarter was about 66% oil with a balance of natural gas and natural gas liquids. It's really changed us from a natural gas company into an oil producer. Grew the reserves to that 40 million barrels. We've increased our acreage position to about 17,000 acres. And in September, our production mix came up to an even higher 71% oil. And we anticipate that staying in that low 70s range with the new wells we drilled. We had drilled a couple wells last year that were in the gassier area that brought our mix down a bit. These last 4 wells that we brought online here a couple months ago brought the mix of percentage oil back up again into the low 70s. Activity for this year, what we've done, we've drilled 4 1.5-mile lateral KEI wells. So what we do is we drill down to between 8,000 and 11,000 feet, and then we drill horizontally. And we were drilling horizontally by about 1 mile. Now we're drilling 1.5 mile lateral wells mainly. We drilled those. We brought those on production, the first 4 of the Lobina wells, and they were coming on with an 82% oil mix. And that's why it came up from 66 to 71%. We're now completing and testing a well on the east side that we drilled in the second quarter. And I've got a slide on that. That's basically in a contingent resource, so it wasn't even an approved probable or possible category. So there's no value for it on the reserve reports. And we'd recently finished drilling 2 other KEI wells, and we're currently in the process of fracture stimulating 4 KEI wells, known as the 2 Barnes wells and 2 Veland wells. Those will be coming on production in December is our expectation. That leads us to our guidance for 2025. Our forecast is for 4,000 to 4,400 barrels of oil equivalent per day. That's a 15 to 27% increase. Revenue up 4 to 11%, even with prices being down. Our adjusted EBITDA is still forecasted to be 4 to 14% higher than it was in 2024. You can see our adjusted EBITDA over the last few years. We've had really nice growth. And even though oil prices are far lower this year, you can see that we're still anticipating growth from that. We have had excess cash as well over what we've spent in the field. So the board authorized a shareholder return policy, meaning we're buying back shares. And over the last year or so, we've bought back about 570,000 shares out of the market. And we'll look to continue to buy back additional shares. Production growth on a quarter-by-quarter basis. You can see here that we've had nice increases going steady up, up, up. And same with our net operating income. The blue lines is the operating income. The red is the barrel of oil equivalent pricing. And you can see the nice steady growth that we've had, which we continue to look forward to, especially with more wells coming on here in December. Tishomingo Field overall, all the infrastructure is in place out here. We're less than 1 mile from the gathering system where our gas and natural gas liquids go. Exxon actually owns that gathering system, so we just pay them a compression fee and a gathering fee. And they do the calculation or the splits between gas and natural gas liquids, maximizing it for themselves, and we get the same splits that they get. Oil is all trucked out of here. The pricing is West Texas Intermediate WTI, less about $1.85. And that's been very consistent over the last 5-6 years. So we don't have any big differentials like they do in some basins as far as pricing goes. Again, Netherland Sewell reserve report at the end of last year gave us 104 additional booked locations in the KEI. 52 of those were in the proved category, 31 in the probable, and 21 in the possible category. And the difference this year was these are mainly 1.5 mile and 2 mile laterals. So in the past, there were more wells, but they were only 1 mile laterals. So now that they're longer, we need less wells to develop those reserves. And so our efficiency goes up. I mentioned we've increased our acreage to 17,000 acres. We have 41 KEI wells on production, looking to put on 4 more here in early December. And our acreage is held by production. So that means that we hold on to that acreage and not having to drill on it unless we want to. So the acreage is held by either Exxon by producing the deeper Woodford intervals. And since we own the intervals above it, it's the same leases. And so those are held by production is what it's referred to as. And that way we have the luxury of drilling where we want to drill, when we want to drill. And then we have additional upside on the east side T-zone and Upper Sycamore, which is what this slide is. So the east side acreage, we have 3,000 net acres out there. As I mentioned earlier, it's listed as a contingent resource on the reserve report, so there's no value attributed to it. We wanted to test it because from a geological point of view, remember when we drilled those Woodford wells, we drilled down through the Caney and the Sycamore, so we know what it looks like in 40 different locations all across our acreage. And then we complete in the Caney so far, we've exploited that one, but we haven't exploited the east side or the Sycamore formation. So on the east side, from those Woodford wells, we knew what the Caney looked like, and it has characteristics that are very similar, like the heart of the field, except for that we knew it was shallower. So shallower means a little less energy. So we wanted to find out what kind of economics we can make out of this well, out of this first well location. So we're the operator, actually. We have a 46% working interest. Exxon is the balance, has the balance of it. They elected to participate alongside of us, and we're in the process of testing it. It's been producing here for a number of months. We're still trying to get quite a bit of the fracture stimulation fluid back until we know exactly what it's going to do. It has lower rates than the heart of our field. It's probably not economic at $60 oil prices, but we're hopeful as we get more production, more fracture stimulation fluid back and get more production out of it, that we can work out to see if it's economic or not in the future and what prices it would take in order to make it economic, because we are making oil and gas out of it. Another formation that we have the rights to is called the Sycamore. That's in between our rights that are above the Woodford as well. So we drilled through all the Sycamore in those initial 40 wells. And a number of operators have made successful Sycamore wells to the north of us and not far off of our acreage. So we've been refining potential Sycamore locations to potentially test the Sycamore on our property. And then we have another formation that's above the Sycamore, but below the Caney, which is called the T-zone. So the T-zone we actually tested in a few wells already. So it has been proven productive with several producing laterals. We are planning on developing that in the future. In one instance, it actually, when we developed that, it interfered with the Caney. And so what our plan is to develop the Caney in certain areas, let it produce. When the Caney's making less oil out of each well, then we'll go ahead and go back in and drill some T-zone wells that have very low risk. And if they fracture stimulate up into the Caney and interfere with the Caney, it's not going to be a big deal. You're just re-stimulating the Caney, but you're not interfering with very much production anymore. So that's the reason that we didn't develop it at the same time as developing the Caney, which we tried in a couple of situations. Again, there's no credit given for these undeveloped locations in the T-zone either. So these are all upsides that are not in the reserve report. Drilling efficiencies, you can see from the chart here on the right, in 2016-17, it was taking us about 30 days to drill down and then drill these 1 mile laterals. By the time 2024 came around for these 1 mile laterals, we were drilling them in 12 days. So the last 4 1 mile laterals we drilled and completed for an average of $5.5 million each. In 2023, our forecast was for a $7.2 million well. So big cost savings by just knocking the number of days down. When we started drilling our longer laterals, 1.5 mile laterals, the first ones were drilled in 14 days, and then the Lovina wells that we drilled earlier this year were drilled in an average of 10.5 days. So we've gotten better and better at drilling these wells. Cost-wise, with some cost escalation that's happened, as everyone knows, inflation has been taking place. We are now budgeting to drill our Barnes wells. We're budgeted for $7.2 million for these 1.5 mile laterals. So really, for $7.2 million for a 1.5 mile lateral compared to what it was for a 1 mile lateral back in 2023. So the efficiencies have gotten much, much better. They were able to access more reservoir, the same amount of dollars. People have asked us, as far as, when oil prices are down in the 60s, do we want to keep drilling the wells that we had planned for the year, et cetera? So we put this chart up here, and this is a calculation of the internal rates of return on wells. And these are based on Netherland Sewell in 2 different types of locations that we have in the proved part of our field. One, well locations that produce more gas. That's the lower curve here. And then the blue line is where location that's expected to produce less gas. And so that has a little higher rates of return. But you can see even in a $60 oil price range, we're looking at 48 to 117% rates of return. So really good rates of return. One thing I will point out is that's based on a $6.5 million well cost. We did have some cost escalations. So it's a $7.2 million well cost. So we just have to move those curves down a little bit. But you can see we're still making really good rates of return, assuming these wells perform like Netherland, Sewell expects us to. And that's why we didn't stop our drilling program this year. And one of the reasons for this is our operating expenses. So this is a comparison of our peers from public data from 2024, the average prices that it was costing everyone to get a barrel of oil equivalent out of the ground. And you can see that the green bar here is us. We're in the very lower end of what other operators are costing to get oil out of the ground. So we're very efficient in what we do. And the operators around us, 3 of the 4, are actually natural gas producers where it flows out of the ground naturally. So we have to actually lift it out because it's oil. So we're doing a really good job of getting oil out of the ground, and that leads to very high netbacks. So and netbacks are how much we get per barrel out of the ground, how much we make per barrel coming out of the ground, I should say. So you can see the calculated netbacks, we're right in the top end of, along with 2 other operators, of efficiencies and how much we make per barrel of oil equivalent coming out of the ground. G&A has been coming down nicely year after year. Revenue has been going up nicely. And a little bit on the management team. Myself, I've got over 36 years of oil and gas experience in multiple roles. I've done a lot of land acquisitions, M&A work, operating experiences. I have a lot of that, a lot of finance experience, and just generally running oil and gas companies over my career. Gary Johnson, who is with us here today, he'll come on the Q&A. He's our CFO. He's got over 34 years of accounting experience, 22 years in the oil and gas industry. For instance, one of his roles was with Occidental Petroleum, where he was director of technical accounting. He's got an MBA from Auburn University as well. And Dan Simpson, our director of engineering, he's over 30 years of reservoir or engineering experience in the petroleum field all around the world. So he's been with us for over a year now, even though we've worked together for 4 or 5 years. Alan Hemme, our senior geologist, has over 15 years of oil and gas experience and has been doing a great job. Our board of directors, I like to say we check all the boxes on them for what we need for the different disciplines to cover everything. Evan Templeton, our chairman, lots of credit analyst experience with in the oil and gas space. For instance, he was with Jefferies for a year as managing director of the leveraged credit trading group. Doug Urch, been a CFO of numerous oil and gas companies over his career. He's the chair of our audit committee. David Newhouser, director, who is a large shareholder through Livermore Partners that he runs out of Chicago. So capital market experience is what he brings. And then Leslie O'Connor, director, lots of reservoir engineering experience in the oil and gas fields. She ran the Denver offices of Sproul and MHA Petroleum Consultants, which are engineering firms. And that brings us to the summary. So we're trading as KGEI on the NASDAQ, KEI on the TSX. We've got what we feel is an excellent asset with a lot of potential. We're an efficient operator. We've got lots of drilling inventory left for the KEI, according to Netherland, Sewell, and also additional upside that we believe in from these other intervals. We try to keep our debt down low. Our debt to EBITDA is right around 1, and it should be coming down even further. In the first quarter, we're expecting to pay down that debt, as I mentioned. Got cash flow that has been increasing substantially. And earlier this year, we were added to the Russell 2000. We're buying back shares in the market and try to run our company in a good, sustainable fashion in order to be able to ride out the low times and maximize everything on the high times. And with that, I'll ask Gary to be able to join us here. And we'll open it up to Q&A questions. So let's see. First question is, and Gary, are you joined?
I'm here.
Yes. Okay, perfect. I can hear you. Great. So first question is, are you actively considering potential, oops, how do I get that back? There we go. Are you actually actively considering potential strategic joint ventures, acquisitions, or asset sales to accelerate growth or de-risk our portfolio? We are not. We're looking around for other acquisitions. We believe we're in good shape, especially while oil prices are down. Other people might not be in as good a shape as we are. So you can sometimes do accretive things. We've been looking at projects for a number of years. We haven't found anything that's accretive because we do feel like we're undervalued. And we don't want to grow just for the sake of growth. But if we grow, then we definitely want to go ahead and grow, but in a creative fashion. So we will keep looking, but we're not looking to do any joint ventures into our property at this point in time. Let's see.
On the bottom and start at the top.
Yeah, I just realized that. Saw the first thing on my screen rather than scrolling. Thanks, Gary. So how does Kolibri prioritize capital allocation between expanding current projects versus exploring newer formations such as the Sycamore and T-Zone? So one of the things I believe in is doing a mix. So like, for instance, this year we put a test well into the east side, but the majority of our wells, we're bringing on 8 wells this year in the heart of the field. So we're growing cash flow and increasing that. But I believe it's always good to have a mix of doing something where you can increase everything in the company, other than just your cash flow and reserves. You take a little bit more risks with a small portion of your capital allocation. That's just how I believe that a company should be prudently run. You don't take too many risks on certain things, but you need to take some risks in this business because you want to keep growing. And I think that's what most investors want to see too, is continued growth from a company. Can you provide, another question, can you provide more detail on the upside potential of the East Side, T-Zone, and Upper Sycamore, and what milestones would confirm commercial viability for these assets? So really it's going to be testing wells. So just like we did on the East Side, we put that well in there, testing it. It's taking a long time to get the fracture stimulation fluid back. Production rates have been steady on that. In this oil price environment, as I mentioned, we would need higher rates in order to make that economic, is my guess on this one. So we'll see how that pans out. But on the Upper Sycamore, we will have to test a well on our property. Like I mentioned, there's some good successes that have happened just to the north of us, very close in actually. And the Sycamore is present on our entire acreage block. So we are doing a lot of work on figuring out where that would be the lowest risk in order to potentially add that. T-Zone, from my point of view, is tested. It's there. It's just a timing issue that once we have a full development in, let's say, a section, a square mile on the KEI, and it's produced for a number of years, then I would recommend coming in there and starting to drill some more T-Zone wells. But in my view, that's completely de-risked already. Let's see. What message would you most want current and prospective investors to take away from Kolibri's 2025 performance and future outlook? I would say that we run our company in a good fashion, where we're an efficient operator. You know, our operating expenses are $7.50 a barrel to pull oil out of the ground. We're still making over $30 netbacks, even in this price environment. So we can ride out, you know, downturns in oil and gas as we're in the middle of right now. Not all operators can say that are our size or public companies. We're not looking to raise any money. We're looking to live within cash flow. We have a lot of upside potential, not only on our property, but we're looking to see if we can't acquire something else around us that would make sense. But again, it has to be accretive, and just try to do the right thing, long-term planning for making the most money for all shareholders. We're all shareholders as well. I covered that one. And then let's see, this looks like this might be the last question. Could you elaborate on the assumption behind your 2025 adjusted EBITDA and revenue guidance, and what kind of oil price sensitivity should investors consider? We ran that on $64, I believe, right there for the rest of the year.
Yes, we had to adjust our guidance down because of the price that was used at the beginning is much lower than the actual price is much lower than what we use. So we use $64 for oil in the revised guidance.
So yeah, oil prices being down lower than that, it could adjust. It could obviously adjust, or it obviously could impact our EBITDA, just because our assumption was for 64. For the longer it stays below that, it will adjust it on downside, or impact it on the downside, I should say.
That's why we try and give ranges out too, just to reflect that uncertainty in the price environment.
Exactly. So it's anyone's guess where oil and gas is. I do believe it's going to be rebounding at some point in time, but I couldn't tell you if it's a week or 6 months. So I don't think things are quite as dire as the market is making it out to be right now. And I don't think any of the producers worldwide, the only ones who have excess capacity left are Saudi Arabia and maybe UAE. And I don't think they want prices to stay down in this range for long. And so I do believe that prices are going to end up coming back up again in the not too distant future. But I definitely don't have a crystal ball on that. And if they stay down here, then we slow down on our drilling potentially and don't spend as much on drilling, prices being up higher, and we spend more on drilling and accelerate what we do. We have the luxury of doing that, and luxury of being nimble with the size that we are. We'll plan on multiple different areas where we can potentially move a drilling and rig in quickly. But again, we have the flexibility of moving or not moving on a quick basis. I think that's.
We have some additional questions actually in there. Well,
are there? Why don't you read that?
Yeah, so what steps are being taken or considered to reduce emissions intensity or improve the sustainability profile of operations in the Tishomingo field?
Okay. Yeah. So on some of the older wells, we are changing out some of the compressors to make them more efficient, to capture more gas in the streams. And we're looking at potentially putting in a single compressor instead of multiple compressors in areas where wells have been on longer. And we don't flare very much gas in the first place when wells are coming on. So we've minimized that. We just have flares out there for when there is a situation that needs it, so it doesn't just get vented, so it does get burned. That doesn't happen very much. So we just try to keep on top of new technology, starting to convert some things from utilizing gas for valves and things like that, automated things, to electric, which emits a little less gas as well. But overall, I think we do a good job of being a good steward of the environment as well. And with the horizontal wells, we minimize the impact of where we are. We drill things from pads, multiple areas. So we try to minimize the environmental impact, and we try to work with our neighbors as best as we can as well, and keep supporting the community.
Another one was, what was the most challenging setback Kolibri encountered in developing the Tishomingo field, and how did management adapt from this experience?
I think that just the most challenging thing is we had to learn when we started drilling the Caney versus the Woodford, we had to make that turn in a different formation. And it took us 3 or 4 wells in order to figure out what was happening and why it was challenging to drill those. And so one of the things is you have to be very methodical in what you do, changing one thing at a time always, because if you change more than one, you don't know what it is. So that's always challenging to say, yes, we can get through this. We know we can do this better. And we eventually figured that out. And then it's a constant improvement after that, in order to get better and better at what we do. But again, changing one thing at a time. So, and we've had downturns during this business, but like I said, trying to do everything methodically and trying to stay conservative makes you survive. And that's what really we've been able to build into. I think that's about it on time.
We're running out of time here. Yeah, I think we're out of time. But please reach out to us if you have any additional questions we weren't able to answer.
Exactly. Thank you, everyone, for your time. I appreciate it.